Ladies and gentlemen, my name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many, many years. We hold events multiple times a week from San Jose to San Francisco. We always have a busy, busy calendar of events. I'd like to highlight one event that's coming up next Thursday, February 28th, Silicon Valley Trends. In 2019, it's another venture capital panel that's going to be at Shenzhen Bay in Santa Clara. So check out the details for that event and all of our events on our website, ideatoipo.com. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 60,000 members among all our meetup groups in the Bay Area. We've completed over 1,995 events. We're the most active, most prolific startup event organization in Silicon Valley, bar none. Is that all I get? All right. So, look, if we're the most active, most prolific startup event organization in Silicon Valley, and Silicon Valley is the global center of innovation and entrepreneurship, we're the most active, most prolific startup event organization in the entire world. Yeah. A little better, but I'll take it. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant, stuff that you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is an aspirational ecosystem. It attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley? Who here was born and raised in Silicon Valley? 4 of you guys, 5. Welcome. So whether you were born and raised in Silicon Valley or just arrived last night, it is important for us to provide multiple channels for you to meet people, build relationships, and grow your network. So in addition to our content-oriented events throughout the week, we also put on some social events, and they're hosted by CJ Terrell, one of our team members. Let's hear it for CJ. Applause.
Hey everyone, I'm CJ. So as Rob was mentioning, we have these TGIF mixers. They're really fun events. We have them every couple weeks, every few weeks. Our next one's actually tomorrow. They're at the Hyatt Regency in Santa Clara, right across from the Levi's Stadium. So for some of you who may know, for reference. We have a lot of people who come out really from everyone across the world, those who are traveling into the area, those who are from the area, and we have no agenda, just kind of getting out, mixing and mingling, getting to know, talking about business, talking about life, whatever you want. They're also free. And if you are interested, again, they start at 8 p.m. tomorrow at the Hyatt Regency in Santa Clara. Hope to see you there. Thanks.
Who likes free events? Well, tonight's event's not free, but I appreciate you guys stepping up. With regard to value, it is important that we provide value at each and every one of our events. Not just value for your money, which is important because we know that many entrepreneurs are struggling financially. So we make sure our events are affordable. If you cannot afford the cover charge, for whatever reason, come talk to me and we can work something out. And at every one of our events, we want to make sure we provide a delicious buffet meal. Is that a delicious buffet meal? Well, let's thank Perkins Coie for sponsoring that delicious buffet meal. Applause. More importantly, though, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable resource. Anyone here getting any younger besides our panel? And these two delusional young men that are raising their hands? Just kidding. So when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. We have many, many partners that help us do what we do. Law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, lots of other players in Silicon Valley. Tonight, once again, we're grateful to Perkins Coie for hosting us at this beautiful venue and providing us with an awesome moderator. So once again, let's hear it for Perkins Coie. Applause. Some of our other partners are here tonight. I would like to have them come up and say a few words. Let's hear it for Ali and Planner.ai. Applause.
Thank you, Rob. Before I start with about Planner.ai, I would like to share that next week on Tuesday, February 26th, there's a great event at VLab at Stanford, hosted by VLab. Again, it's vlab.org on breakthroughs in diabetes. We have a great panel, the CEO of Bigfoot, a senior director from Viasat, and a senior director from Abbott. And we cover topics like, is artificial pancreas a real thing? Are we getting closer, are startups getting closer to a cure or treatment for diabetes? It's a great event. Please, on your way out, pick up the flyers from the tables. And about Planner.ai. As of January 2019, there are more than 1 billion devices on which Google Assistant is installed. 1 billion devices. It's a great time to be a voice app developer. And its marketplace is much bigger than the iOS or Android app development marketplace. If you want to become a voice app developer, please find me in the back. We have a personalized coaching service that can help you become a voice app superhero. Again, Planner.ai, we have a personalized voice app coaching service. Thank you so much.
Next up, we have Josh from 42.com. Applause.
Everyone, so my name is Josh. I'm from 42 Silicon Valley. We're a completely free project-based peer-to-peer programming school. Our founders have been involved in education for over 25 years. We started in Paris 6 years ago and have been in Silicon Valley now 2 years. Best part about it is we're totally and completely free. If you want to find out more, come see either Shauna or myself afterwards. Shauna's over there, outside. Thank you.
Free is good, right? Next up, we have Tahir from Hello.ai. Applause.
So we are not free, but we are disrupting the healthcare voice engagement market with exactly what you've heard Sundar Pichai demo at the Google I/O, where there was a bot talking to a person making a reservation. We do that for healthcare companies for use cases around lead qualification, appointment setting, satisfaction surveys, adherence, and those things. Our traction till date, we've had 2 million conversations on our platform. We are revenue positive for the last 9 months, and we are actually growing month on month at 40%. So we're happy to show you the tech at the back. My co-founder Angad and I are here. Would be very happy to talk to anybody who has got a use case that they want to disrupt with voice, because we make voice digital. And thanks a lot, Rob.
All right, next up we have George from Inline Balance. Applause.
Hi, my name is George. I'm here from Inline Balance, and the problem that we're solving our company is in physical rehab and weight training. Most people are asymmetrical. They favor one side over the other, and our device instantly corrects their form. It records their velocity, their acceleration, and we developed a tool. We're looking for someone, a partner, to help us to go to market. If you're interested, please come and see me after. Thank you.
All right, last but not least, Brian from Venture Capital Roundtable. Applause.
Appreciate it. Hi, everybody. Welcome. I'm Brian Phelps. I'm the Senior Director of the Venture Capital Roundtable. It's an organization that's been around for 20 years. Our membership is comprised of angel investors, limited partners, general partners, institutional investors. We have about 55 members. We meet once a month, and we're always looking for entrepreneurs to come into our deal flow lunch. We invite 4 entrepreneurs who are vetted to come in and pitch to our membership. So if you are ready to pitch and you would like to schedule some time, come see me. I'll give you my card, and we can make that arrangement. Thank you.
Though our mission here in Silicon Valley is to support entrepreneurs locally, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Go check it out. We have tons of videos there. We've documented and archived many of our events. And this rich, valuable content is available on demand, anytime, anywhere, totally free of charge, whether you're in Palo Alto, San Francisco, New York, Maui, Moscow, or Timbuktu. Our partner in this endeavor is Tim Jeggers of Jeggers Films, one of the top professional videographers in Silicon Valley. So let's hear it for Tim. Applause.
Thank you, Rob. Thank you, everybody. So I'm Tim of Jeggers Films. I do all kinds of multimedia production, photography, video is my emphasis. I do a lot of events. I also do marketing content, photography. I manage some social media accounts. I shoot real estate, and I could go on and on and on, but I'm not going to take up everybody's time. Just wanted to introduce myself, and if you have questions about the YouTube channel for Idea to IPO, I'll be in the back at the end of the night. And if anything else that I mentioned is of interest, feel more than free to ask about that as well. Thanks for the time and coming. I'll pass it back to Rob. Thank you.
All right, ladies and gentlemen, so here's the schedule for the rest of the evening. Our panel will launch into a spirited, informative, entertaining, and dynamic and compelling discussion, right? Audience members, hold on to your questions. We're going to open it up to questions at 8 p.m. We're going to form a line here, and anyone with a question can come up, use the microphone. We'll take questions all the way up till 8:30 p.m. At that point, we'll end the formal program, and you can hang around, network, socialize, and connect. As a courtesy to Perkins Coie, we would like to leave the building by 9 p.m. So at this point, I'm going to pass it off to our distinguished moderator. He is one of the top corporate and startup attorneys in Silicon Valley. He's a partner here at this prestigious firm, and he is passionate about helping entrepreneurs succeed. So let's give it up for Armin Palavan.
Rob, first of all, I wanted to really thank you for doing this. It's an amazing job that Rob does since 2010 to 2019. We're looking at a decade of your doing this, and frankly, I don't think anybody pays you to do this. I think you're doing this out of the passion for the ecosystem in Silicon Valley. But I really, my hat off to you and everybody else that you bring in to help you, because you guys are doing a phenomenal job, and you really are part of the ecosystem here. So, as for a Shakespearean play, applause. So, with that note, I just want to tell you just 2 words about myself. I'm a partner here at Perkins. I do focus on emerging companies, venture capital, and private equity. That's all I do. I do 3 or 4 things in that, paradigm. I do the financing transactions. I help entrepreneurs get connected with the right people. I do fund formation for the venture capitalists, and we do the M&A transactions for the entrepreneurs and the venture capitalists to cash out of deals. So that's the brief paradigm. I love doing this, and I'm really happy to always meet the great panelists that we have here, which it's formidable. And what Rob is doing, and what we're all here, this is really part of this ecosystem that contributes somewhere around 35% to the GDP of the United States out of this, and I would say 50-mile kind of a radius. So this is the ecosystem. It all starts here. So thank you. Thank you to all of you who are here. With that note, I would like to ask, if you want, Rich, we'll start with you. If you could just do a brief presentation about yourself. And then after you do that, I will do what you want me to do, which is go through the audience and get there, see where they're coming from and what they're doing. So please, go ahead, Rich.
Okay.
Great, thanks.
Sorry. So my name is Rich Simoni. I'm with Asset Management Ventures. We're an early stage VC group based here in Palo Alto. Do primarily seed and Series A financings in technology and life sciences. Significant emphasis on digital health since 2008. So we've been doing this about 10 years within the digital healthcare space. The rest of what we do is technology and mostly therapeutics within healthcare as well. My own background is I'm a old tech guy, refugee, I guess you'd say. I came out here 30 years ago, originally to go to Stanford for grad school. I stayed at Stanford for master's, PhD, postdoc research, all in the electrical engineering department. So hardcore tech geek by training and by nature, I guess. Since that time, I was an entrepreneur. The firm where I am now, AMV, funded my company, and that's how I got to know our founder. And I joined him in 2002, so I've been doing this for a little over 15 years now.
Go ahead, Gabe.
Hello. Thanks everyone for coming. I'm Gabe. I'm with Comet Labs. We're also early stage investors. We focus on AI and machine learning technology. So instead of being sector focused, we focus across sectors, but where AI and machine learning can be applied to traditional industry. My background is I'm a recovering entrepreneur. Went to Stanford for undergrad and grad school. Made my attempt at starting a company. Very meager and modest attempt, and then went over to the investment side. So now really focused on, helping startups raise capital, bring their early ideas, their early products out to market, and try to grow and build a company around it.
Hi, I'm Ephraim Lindenbaum from Advanced Ventures, and Gabe stole my line. I'm a recovering entrepreneur, and I am a recovering entrepreneur. So I've actually sat in your chair on the other side. I grew a business here in Silicon Valley and exited in the first .com boom. Might be a few people here remember that back in '99. And then we spun up Advanced Ventures in 1999. We're one of the few remaining '99 vintage maiden funds out there, which means we're definite gluttons for punishment and probably pretty good at what we do. We've invested in this category, digital health, for about the last 15 years and quite active there as well. And to Armin's point, this is the greatest time to be an entrepreneur in Silicon Valley. Having been one myself a long time ago, there are very few options for capital. Now we have people like Rob who put programs like this. We have accelerators, incubators. This is the greatest and, frankly, easiest time to be an entrepreneur in the history. So hopefully you'll have great questions that we can answer today.
That's fantastic. Just a couple of words about asset management. So Pitt Johnson, which you mentioned, you're the founder of the firm, is really one of the, I would say, 5 people that started off Silicon Valley in its venture capital, beginnings, with Don Valentine and Dick Kramlich and a few other folks. So asset management has been around for a very long time, and it's gone through various, more metamorphosis, and it's great to have you here, Rich. Thank you, and everybody else. Gabe, you're the youngest member of our team, so I think you're going to be carrying the helm on a going forward basis, so we welcome you to the panel as well. So before I get to the discussions, I want to hear just a few questions from you guys as the audience. So I want to see which one of you guys is an employee of a health tech company? Not a founder, not a CEO, but an employee. Okay? So any people from the government side in the audience? Usually Palo Alto has very little government employees, so I was expecting the answer to be no. Anybody in the audience is a lawyer, in which case you can see the door, you can walk right out. Journalists, bloggers? No? Which one of you has founded a company, whether in healthcare or is a founder of a company? Oh my God. Pretty good showing. Which one of you is a founder of a healthcare company or life sciences? Nice. Yeah, so we got about 7 or 8 people. Fantastic. So we wanted to kind of like today focus the discussion around healthcare and life sciences, and it's an interesting part of the venture capital paradigm, because for a long time, healthcare was defined differently, or healthcare investment was defined differently than what it is now, right? For many, many years, we were doing basically bio and drug companies, and then we had medical device companies. So Ephraim, just starting from you, could you give us some of the current metrics about what's happening in the venture capital world? What is the data showing us about how much money is going into venture capital as a whole, how much going into healthcare as a whole, and then if there's any segmentations of the healthcare to see the dollar amount either on the percentage basis on geographic. So I know you love those things. And
Well, we tweet a lot. So if you follow us on Twitter, every morning at 7:30 a.m., our firm puts out a digital health tweet. And it's usually what we're thinking and what we're reading and what we have sort of in our top of mind. And I'm just stealing from something we tweeted a couple weeks ago. So last year was the biggest year in digital health funding. And instead of kind of going broad with VC, I'm gonna just kind of give you an idea. So roundly in 2017, there was about $7.5 billion invested in the digital health space. In 2018, that number went up to $9.5 billion. So that was a 32-ish% increase in that year-over-year growth. There was over 1,000 deals. Most of them were concentrated in the United States. Now, an interesting statistic that goes along with that is what type of deals? And to Armin's point, historically, this was a life science category, a device category, drug development, things like that, therapeutics. But today it's very much a consumer-driven. In fact, more money went into consumer-driven digital health companies than anything else, 447 to 215. And beyond that, and I think what's very exciting as an entrepreneur is we saw an incredible uptick from $7 to $13 billion in what we call corporate venture capital. That's the Johnson & Johnsons and the Tevas and the giant healthcare companies investing in this space. Recently, last week, was a big HIMSS conference on the East Coast, digital health being one of the #1 data points there. So you're in the right category. They estimate this to be a $537 billion space by 2022. That is one of the biggest. You get up there, it's healthcare, and it's food, and everything else pales beyond comparison. So you're in the right space.
So, just to give you some idea, about 30% of the venture capital funding of over $100 billion went into healthcare space. And of that, digital health was getting always the smallest amounts in single-digit percentages, right? And so, we've seen a large kick-up in terms of the digital health. And what we're talking about is the corporate venture capital space. Now, talking about corporate venture capital, I think it'd be very apt, Gabe, for you to jump in and tell us about your fund and where are you seeing early stage investment come from CVCs, from corporate venture capital, and where they're focused or whether there's a focus in healthcare in terms of segmentation of the larger digital health space.
Yeah, I think that's a great question and one that we're always looking at. So at our fund, we are structured similarly to a corporate venture capital fund. We have one LP, one major investor that is giving us money to invest on their behalf, and they're a large corporation overseas in China.
And they're the largest shareholder of Lenovo.
And they're the largest shareholder of Lenovo. So we do take in mind a lot of their strategic priorities. How are they trying to grow? What business units, what business lines are top of mind? And then how does the market in China affect how they want to invest in the US? So what are the tools? What are the technologies that they want to bring overseas, given their view of the landscape and the market development over there? What we are seeing specifically, and what we're seeing the interest of our corporate in investment in healthcare, is looking at how do they improve the distribution of healthcare in an environment that is very segmented. There's a large rural population. People cannot always come into the city to centers where there are doctors, to hospitals, to care delivery centers, and that makes it a very different challenge than what you have in the U.S. The physician count, although there is a shortage in the U.S. of physicians, and it's a population that continues to get smaller. It's much smaller as a percentage of the total population in China. So they're looking at tools that help them extend their reach, extend the delivery of care, and help them deliver care to the entire population, not just the population that is concentrated in city centers. And this is everything from telehealth tools, remote monitoring tools, to technologies that help them more quickly deliver medicine, more quickly deliver care, more quickly access and reach the patients and understand what their needs are. So that's the way that we're looking at the landscape. But it all depends on the geography and the environment that your corporate operates in.
Great. Rich, when you mentioned in 2002 that you joined the fund, what was asset management doing in healthcare, and how has it shifted, to the extent it has shifted, from its investment strategies back then or pre-2002 versus post-2002, and what are you seeing in terms of, you know, the innovations that are happening, you know, in the space?
Yeah, it's
in general?
interesting. So we were, like a lot of firms at the time that were doing both healthcare and tech, we were very siloed at that time. We had a tech practice and a healthcare practice. Healthcare practice was exactly as you described it. It was therapeutics and medical devices. Interestingly, the tech practice at that time did get involved in some of the early HIT, healthcare IT companies that sprung up in the late 90s, and all those efforts completely failed. It's like the healthcare system wasn't ready for it. The infrastructure for doing it wasn't really there yet. It failed for many reasons. So we kind of, when we re-entered the digital health space, we did it with, I'd say, 2020 hindsight, with the arrows in our backs from what we'd done in the late 90s and early 2000s. But in around 2008, you know, I mentioned the silos. We de-siloed because, for two reasons. First of all, we saw thematically that it was going to be an interesting investment area to look at technology as applied to healthcare. And then bottom up, we kept getting plans from entrepreneurs that we weren't sure which side of the house to put them on. Like, is this a tech deal because it's really a bunch of tech under the covers, or is it a healthcare deal because those are the markets they're going after? So seeing both, you know, thinking about both of those things at the same time, we decided to operate as an integrated team. And so, you know, one of my partners is completely focused on digital health, another one's an MD, PhD, and I'm an old tech guy. And we're operating as a team in this space. And it's been great. Each subsequent fund from 2008 forward has had more digital health companies in them. And, you know, I think, and the areas that some of the areas we're interested in, we look at a lot of digital therapeutics. So, you know, companies that are bringing digital solutions to particular diseases and conditions that people struggle with. We're looking at some of the same stuff Gabe mentioned, really scalability solutions. How can technology be used to scale the efforts of healthcare professionals? And although we look at it mostly from the viewpoint of the United States, because you know, I think the shortages here in care personnel is getting worse every year. The need is perhaps an order of magnitude greater overseas. We're looking at there's so many more data sets that exist today than used to exist. So we're looking at opportunities for new applications around those data sets. A big part of what we're doing today is also around precision medicine and genomics with respect to that, early diagnostics. And we're doing, we see a number of interesting companies that are doing things in clinical trials as well. It's a little bit, maybe it's not quite mainstream digital health, but you know, it's kind of pharma tech. And yeah, so those are some of the areas that we're looking at these days.
That's great, and I want to get to it. There's so much to talk about in each of these discussions, or each of the questions that are so loaded, and there's so many topics to kind of follow up on. So, since Gabe, you have the single LP that is so deeply inside into computing and into the the larger concept of computing and computers in general, what is the role of AI in these health tech companies that you guys are looking to fund? Is it a necessity to have some AI components, and I'm guessing that that's probably a loaded question as well, right? Because some of that is just the expansion of where the technology is going. But what are your perspectives about AI and its role in health tech companies that you guys are funding?
Yeah, so I mean, I'll start by saying for us, it's a necessity for these companies to have AI as a core component of the technology to make an investment. And that's
Right.
just the mandate of our LP.
And that may be just because that's where technology is going anyway, because it's hard to find technologies that don't have AI as a component.
Mhm.
So, but go
Yeah,
on.
but then as far as, what is the role of AI in healthcare, I think that's a much broader question. And I think there are a lot of opportunities or areas in which AI can play in. Some of the areas that I'm excited about is, like Rich mentioned, there's a lot more data in healthcare now, more than ever before. People are wearing devices. People have their phones. This is constantly monitoring their movement, their sleep, in some cases, their heart rate.
Right.
So there's a lot more information that's accessible. This information, though, is not, in the current state, not very actionable. It's a huge lift for individuals to look at the information, to analyze it, to interpret, and to parse out what exactly it means. So where we think AI plays a huge role is in assisting this process. Looking into the data, finding these little insights, these little nuggets of information, or these little aha moments that will help us understand what individual information, what data is a predictor of a certain disease or the progression of the disease or the onset of a disease. And we think that's where, in healthcare, a lot of advancements can be made. The earlier that you can get to a patient, the earlier that you can identify that something is going wrong and get them back on track, the better chance you have at improving the outlook for the individual, and also the better chance you have at reducing the cost and the burden to the overall system.
Hey, Gabe, I'm just curious. Of the decks that you see from startups that are telling some great story about their AI, when you look under the covers, how many of them actually have amazing AI versus it was kind of, deck hype?
Yeah, that's where our job really comes in. It's trying to identify which startups have true innovation in AI, have true technology there, which ones are claiming that they have AI, but it's just some more advanced data analytics. Because it's a hot term, it immediately increases your valuation. It gets you more hype, gets you more interest from investors. I would say personally, for the time that I've been investing, 5 to 10% of the companies have true AI. The rest, are working with data. They are, innovating to some extent, and they can be perfectly good companies, perfectly good business models, but they're just not a fit for what we're looking for.
So Rich, you seem skeptical. Is it too high, 10%, or is it 1% to 2%?
Oh, I don't really know. He's the AI specialist, so I was just curious. It seems like every deck that comes around these days has AI incorporated somehow. I think a lot of people just sort of, took their deck from a few years ago, did a global replace of big data, stuck in AI, and here's your new deck.
You sprinkle in a blockchain there. You got to get some blockchain in as well.
Good point.
So, thanks, Gabe. We'll come back to some of these, obviously, as part of the discussion. So, Ephraim, I was, wanted to have you kind of focus on having one of these folks here that have started a company, and they want to get a group together to go out there and pitch to the venture capitalists on a healthcare deal. What are you looking for? What are the obvious ones that you say, nah? What are the good ones that you said, definitely yes? Where does capital efficiency fall into this? Because I think the premise for what you guys are doing now versus what you were doing in the 90s is that the AI, component and the health tech component versus the clinical trials component and the PMA components are quite different. And where is the landscape for those couple or three issues about launching companies and where things are definitely going to go thumbs up and what would be your advice?
Sure, sure. So there's probably a book in here eventually, but
That's what I figured.
the short story is this. I mean, the fundamentals of any good investment, at least from our lens and through most venture lenses, revolve around teams. There is going to be some basics that we're going to look for as a startup to begin with, whether you sprinkle in blockchain or AI, et cetera, right? I think we tend to be less focused. We don't have a specific mandate like Gabe's fund does. And I think we tend to be a little more pragmatic. We had an exit in AI in 2004, and we thought we killed it, we're done, we never have to go back, but apparently it's back. So, we view it from these baselines, right? What does the founding team look like? Does this technology have either one of two areas? We tend to break companies into two kind of categories, either brave new world or better, faster, cheaper, right? And that's a really important point, which is how do you fit into these boxes? Are you streamlining, adding efficiency, saving costs, improving certain outcomes, or are you really breaking it down? Are you creating new, therapeutics, new drugs, new breakthrough technologies? And that's important because the way we're going to view that and the way that we'll look at the return, how much capital goes in, et cetera, makes a difference. The team, as I mentioned earlier, that is arguably one of the most important factors. And the first thing to look at is we will not invest in a single founder. So if you're a single founder, go out and find another founder. Okay, there's even websites called founderdating.com that you can just, if you can't get your own, there's like Tinder for founders, okay? You can do it later in the back. So that's one of the important things in there. Then we look for some other factors. And, to Gabe's point, his fund has a specific mandate AI. We have some factors in there as well. So before we're going to make an early stage investment, we look for a nearly complete team, which is typically 2 to 3 individuals that typically will have very symbiotic roles in the creation of a startup, right? We can get into the personalities later.
And it's okay if they don't all work on a full-time basis on the deal.
Well, it depends. I mean, we're gonna sort of view that through lens.
At that moment in time.
Well, that makes a difference to us because the next thing I'm going to mention is we're looking for an MVP. Does everybody know what an MVP is? Minimum viable product, right? So we want to see it work. Okay, it doesn't have to be great, but it has to do it. And then this is the real kicker. We need to see some level of customer interaction, right? That doesn't just mean, geez, we've got a great idea and we're going to knock down the world. We want to be told by a prospective customer, they don't have to give you money, although that's ideal, why this is so important. Because it's less interesting to us and actually a lot less interesting to the founders than what the customer says. And we want the founders to be informed by the customer. And oftentimes, what we invested in the beginning is not what those companies end up being. So a good founding team that listens to their customers can really evolve into a great business. So we have some baselines. A near complete team, a minimum viable product, some level of customer or revenue interaction. So if you're not doing all that, then you're probably a little early for us. And that's what I was mentioning earlier. There are tons of accelerators, tons of incubators where you can meet the other founders, you can get that minimal viable product up and running, and then you can come back to us. Then following down that path, also, no offense, and I'm like the worst guy in the world, and I apologize in advance. You can email me for the rest of your lives. I will never get back to you. I'm just going to tell you right now. And the reason for that is you can't imagine how many other people are emailing us deal flow all the time. And it's not that I don't want to, and I really do, and you've got a really great idea. It's just there are 1,000 things on fire in my world that precludes me from answering every email. So what we do look for is people to introduce you, right? If Armin sends me a deal, I'm going to look at it because he's been in the Valley a long time. I'm going to be in the Valley a long time. We may end up doing business together for the next 20 years. So he's going to be a natural filter, right? There is some AI coming into this stuff, but we look for the human filter, an accountant, a lawyer, another person that we trust, one of your board members or advisors, people like that have been in the Valley that we're going to interact with, that we believe their reputation is such that they're not going to send us something that's garbage and waste our time because we won't look at the next deal from them. So that's a huge data point. And entrepreneurs always run into this, which is, I've sent you 5 emails. Why didn't you get back to me? Because I just want some advice. And I'm like, well, geez, if I had enough time for my own advice, I would do that. but I don't. So, you know, you have to look at these pieces. So go get a good attorney. An attorney is the most important thing for a startup and that you can have. They're going to make sure that your corporate element's founded well, and that's hugely important. We had an amazing startup that chose LegalZoom in the beginning, and when we were doing a $40 million B round, we had to find the agent that signed the document at LegalZoom, and the guy was like 5 years gone. I mean, we literally had to get waivers upon waivers. It cost probably $100,000 to get it done. So get a good lawyer. Your lawyer is not just a guy that's, you know, Hunter S. Thompson. Bring your lawyer everywhere you go, and then get him to do it for free. Ideally, he'll defer sometimes. Push him.
That's a great plug for lawyers. Thank you, Efraim. But
I'm here for you.
now I know you have some visceral reactions to these, so I'm gonna poke you with some of this. How about a clinician as a founder?
Oh, that's the worst. Are there any doctors out here? Okay, all right, that's okay. Get a co-founder. Clinicians make really challenging entrepreneurs. I don't know what they did to you during med school or residency, but you were damaged. And at the end of the day, you know, when we're investing because we have a desire to gain an outcome. This isn't a hobby, this isn't our second career, this is what we do for a living, and we need you to do the same thing. Clinicians are very challenging. Now, on the founding team, that's fine. I mean, we have a great, you know, we all talk about what we all invest in, and, you know, we try hard to put bets in a lot of categories. So we have a great, you know, highly focused app that diagnoses migraines. That's like a huge problem, right? And these guys solved it. But it's like two clinicians, two neuroscientists, headache, migraine experts. It's like the Ben and Jerry of digital health are running this company, right? I mean, I don't know what happened. They were at Woodstock, but, you know, it's never going to go. We call it a zombie now, right? They're doing great, but I don't know. So don't do that.
So since we're going to write a book about this one question, I would love to invite the two of you. So Gabe, pick any part of that equation or the discussion. So capital efficiency. Is this a key item for you when you look at deals? Since you have unlimited amounts of money, I think it's really relevant for you to respond to.
Or more importantly, they sell everything to China, and there's like 1 billion people over there.
There you go.
No, it's definitely a key element. I think, you know, just because we're under a corporate, we're still a small venture fund. We invest a limited amount of money into these deals, and we want to know that you are going to be able to hit milestones to get, you know, to your next round of funding. And I think what's more important than, you know, capital efficiency from our standpoint is keeping the company alive. So the way that we look at it is, you know, how are you going to use the money that we are giving you? What are the metrics, the milestones? How are you going to prove out the product that you have? And how are you going to show your next round of investors that you have done that and that you merit, you know, your next round of funding? So I think that's what we are. You know.
So you really look at it from the same basis as all other venture capital funds. You do like capital efficiency. It's important to you. And are your rounds really tied to a 2-year type of milestones for the company? Do you follow the same thing, or are you a little bit more lax on some of those metrics?
No, we follow the same thing. I think we're in the, you know, environment of Silicon Valley. It's a very standard process, right? You raise one round of funding, you have 18 months to 2 years, really 18 months, before you have to raise the next round, to show that you are continuing to progress, to show that you are still relevant and that you have a product that's actually going. I think if you let too much time pass and you haven't really made progress with the product, grown your customer base, everyone's going to wonder what you've been doing.
And you know, are you agnostic to valuations? Because, you know, strategics are supposed to have really significant, pots of cash, and they don't care about the valuations of companies, and people come to you to get high valuations. Where are you on that scale?
No, we are not. We are very cheap. We want, you know, reasonable valuations. We will pass on deals that are too expensive for us. You know, from time to time, there is a company that we really want to be a part of, that we're really excited about. We think it merits a higher valuation, or we're willing to, you know, pay up for it. But for the most part, you know, we're not valuation blind.
That's a good point. I mean, we should dive into valuation because early founders show up at the office with like outrageous things, and I want to touch on that at some point. So let's come back.
We'll come back to that. I want to just, since I've got Gabe on the spot, I want to go a little bit further. So, so how about the issues about, you know, China, right? So the two biggest markets in the world, obviously, is the U.S. and China. And when we talk to our China, you know, investors, they all claim that they're going to open up the Chinese market for them. Yeah. right? And we always kind of sit there and say, you know, is that really true? And we roll our eyes and, you know, wait and see. What do you do in that respect? I mean, I'm sure there's, and I'm saying this with credibility because you really do have a very credible, you know, LP. So what do you do and how do you do this? And at what stage do you get your companies to
Are you
be
asking
introduced?
him if he's a spy? I mean, let's just lay this right out here. I mean, are you secretly like sneaking things off to China?
Yeah, so I think that is something to be.
So you heard it here. He said yes.
yes.
We heard that.
So I just want to make sure you guys
Just make it clear.
couch this on tape.
Yeah, we're going to need to erase this part of the YouTube.
This is on YouTube, like real time. It's streaming. Yeah.
No, I think that's something that we need to, you as founders want to be wary of when selecting the investor that you work with. They can promise you everything in the world. You want to, you know, also do your diligence. Just like we look at the companies, we look at the founders, we look at the history. I would encourage you to do the same thing. Really know who you're taking money with. This is going to be a relationship. You will be working with that individual, whether you like it or not, for a period of time. To your point, I think we are one of the CVCs that does, you know, really back up the claims that we make. Something that we do to open the market to China is when companies reach, you know, a certain point of product readiness, where they've tested their product in the US market, they have a baseline number of customers, they have something that they can sell, we organize trips overseas to China to meet with large enterprise partners that they could sell their product to. And this has been very useful to opening up that market. It's, you know, in the trips that we've done about 4 to date. 100% of the companies that we have brought overseas have left China with pilot agreements with these enterprises. And I think that's something that they are very excited about. And most founders, you know, have not had that kind of experience. You know, the other side of it, a lot of entrepreneurs, a lot of founders, they've created something that is unique, that is special. They're wary about protecting the technology that they've built. China is very different from the US. You know, there's not the same IP protection. Your lawyer, you can't just sue a company. Your lawyer can't really do much when it's overseas. But the way that it works out there is if you are going into the market with a very large, powerful, well-known entity, most people are going to steer clear and leave you alone. So as far as what we can promise from the IP standpoint is, you know, our corporate partner is one of the largest organizations, one of the largest enterprises in China. Most people very much respect them, and they will, you know, very much stay out of your way and let you operate.
That's great. I mean, I wanted to actually highlight that because this really is an important issue about how companies go to market. Now, Rich, you've been doing this for a long time, so I want to get into discussions about the climate of the markets for raising venture capital. And you and F can talk about the valuation issues. What is the market climate for raising early stage, you know, seed/early stage venture or Series A ventures?
So there's more money awash in the valley right now than I can ever remember. It's kind of crazy. At the same time, if you look at the statistics, I think that there are, you know, it's becoming more concentrated in a way that more and more of the capital is going to fewer companies. So even as you see the total dollar amounts going up, you're seeing the number of deals actually taper off or even go down. I don't think that's necessarily true within the digital health subsector per se, or the health tech subsector per se, because it's growing within the you know, within the overall VC market. But it's a good time to be raising money. There's a lot of capital out there. I think investors right now are beginning to get a little nervous about what the economy may hold in store for the next couple of years. But for right now, the money's still flowing. I am absolutely shocked every day when I open up you know, the news and see what financings have been announced in the past day, how often there's a financing announced of over $100 million. That used to be a very rare thing. Now, I think last year there were well over 200 financings like that, which means there was nearly one every single business day. So, you know, obviously those are later stage deals. Those are not typically Series A deals, but it's just indicative of the money that's out there.
Yeah, and to follow on with that, I mean, I think a lot of it comes down to the size of the venture funds. I mean, historically, they were much smaller than they are today. Many of these large-scale funds, the classic Valley funds, are well over $1 billion. It precludes many of them from writing small checks because they would have thousands and thousands of investments if they wrote $2 million checks for a $2 billion fund, right? But that being said, you know, the right deal can come to the right spot. But I think, you know, to most entrepreneurs who are here today, it's important to think about the earlier stage money, you know, and the ability to find this capital in pools of capital that are available to you today to get the ideas to the point where they can get to us. And that's always the hardest part, because if you're executing on your idea, if you're building a good company, if your customers like it, we will like it. Right, but you have to get to that stage first. So that's where things like the accelerators, the incubators we're talking about are so incredibly important. There's lots and lots of angels out there today, more so than I've ever seen, that, you know, beyond the, you know, friends and family, we call those the 3 Fs, right? The friends, families, and fools. There are professional angel investors out there. And those are the folks that may have domain expertise, they might be healthcare people, that can be helpful beyond just writing you a small check, right? And those are the important factors to build the pieces it takes to actually come to people like us. And valuation, I'm just going to touch on this because I think one of the biggest mistakes an entrepreneur rolls into our office with is irrational valuation expectations.
What's irrational?
Sure. I mean, you know, we see entrepreneurs roll in with, we're going to raise $10 million. You know, we're here to raise $10 million. I don't know if there's like a, you know, book somewhere that said put $10 million out there, or they actually, half the time they don't even know what they're going to do with $10 million. So we like to see successive, and I think Rich brought this up, successive financings. You know, hitting milestones, growing it. And, you know, valuation is, you know, high valuations are not always an entrepreneur's friend, because if you don't live up to the expectation, comes the next round, which is a down round. And we jokingly say, it's not just a haircut. The higher the valuation, the down round, you're going to be shiny bald, not just a haircut. So you really have to think through, how much capital do you need to get to, as my colleagues were saying, that 18-month cycle, the 2-year cycle, to get to the next milestone. We want to see you Lego block your way to building the skyscraper, right? Because we know that if at each phase you've hit a milestone, you've raised some money, not only are you well versed in this, but it's a sound business.
Go ahead, Rich.
Yeah, the other reason to do that is even if you could raise a huge slug of money at the beginning to finance the whole shebang, you're going to sell way more of your company by doing that than you will if you stage it with the appropriate amount of capital to match the milestones that go along with it. Because each milestone you hit is going to increase the valuation of the company. And so you're raising much more of the capital later once the company has already proven it's worth a much higher valuation. So you end up raising you know, the same amount of capital maybe in aggregate, but a much higher percentage of it has been raised at a much higher price than at that lower price that you get early on.
So there's one thing this was going to be my theme. You know, Armand had a much better plan than I did. But my theme for the night was going to be real businesses. One of the biggest problems we've seen in digital health today is that there's a huge adoption cycle. The ability to actually get customers to pay you money for things, that customer being the healthcare industry, individual clinicians or clinics, or even consumers. And that, to me, is the #1 factor that we're seeing out there. And, you know, we just tweeted about this the other day. You know, we're tired of healthcare companies saying, I'm a startup 7 years later with no customers. I mean, and you could look at it. A good friend of mine's a co-founder of Pear Therapeutics. She was in my office the other day. She's now a director at a lot of other companies, but their revenue is nowhere near where their valuation is. And you know, they're starting to get to the point where that's an issue. Where
This is paratherapeutics.
Pair, yeah, sure. I mean, and at the end of the day, I mean, not all companies are going to get to skate all the way there without having that. Meanwhile, we saw a little startup that was doing online, crowdsourcing of, healthcare conditions and being able to find answers quicker. And they've gotten to revenue and customers and everything else. They've spent like $600,000 and they're generating revenue. And it's a huge opportunity. We'd rather see smart, sly entrepreneurs that have good ideas that are fixing real problems because the customer base will show that. So that's the number one thing. How are you going to make money? Not just solve a problem. And don't be a solution looking for a problem.
And this is the challenge in the digital health space, whether it's on the on the therapeutic side or not, is that the ability to actually make money, and that's where lots of these companies just falter. I mean, and making sure that they stay with the business plan. But I have some quick questions to ask you. So some of it based on the discussions we had. So I want a thumbs up or thumbs down, Rich. Precision Health. Thumbs up or thumbs down?
Thumbs up. I think it's potentially very disruptive based on early diagnosis, genomics and other genomics. But timeframes are important for investors. And so, the time needs to be right for a particular technology or company that's coming down the pike. Having said that, companies that are successful in doing that are potentially very disruptive to the way particular conditions are managed today.
Interesting. So, Gabe, thumbs up or thumbs down? Pharmatech.
Yeah, I think pharmatech is, I'm thumbs up. I think there is a lot of opportunity for disruption. It's a huge cost at the moment to develop a new drug, to do the research, to get a candidate out into trials. So there's a lot of opportunities and entry points to disrupt that industry, to shrink the cost, to shrink the time of trial, to shrink the development of a drug overall. So thumbs up. Again, timelines are important for investors, like Rich mentioned. So it's about finding the right company, finding the right technology, and finding the correct entry point into the market to start.
Great. Ephraim, food and farm technologies. Thumbs up or thumbs down?
It's one of our largest investment categories.
Why? Nobody else. Everybody thinks it's a dog.
Food and health?
Yeah.
No, food and farm?
Food and farm.
It's actually, frankly, one of the fastest growing sectors in the entire investment category. If you look at it,
I could get you fired up.
Oh yeah, I mean, come on, they're pretty much two things: healthcare and food. These are the two biggest businesses in the world.
You and Eric Schmidt are the only people that are.
Well, I didn't even bring up cannabis yet. I made it all the way through to the end, and I didn't bring up cannabis.
Let's go.
I mean, come on, guys. I mean, this is the first time. So yes, we think that's a big category. We're big investors there. Many of our companies are using it as a way to collapse the adoption cycle in digital health, in pharma, in diagnostics, in food, etc.
Great. We have just a couple more questions, but I'm going to hold these. So, how many of you raised your hands about being CEOs of healthcare companies? Okay. 1 minute presentation. What do you do? Right there. 1 minute. 30 seconds. Okay. Who else? Go ahead. Great. Go ahead. Okay. Who else? Go ahead. Great. Targeting what again? Great. Who else? Go ahead. Great. Who else? Go ahead. Speak up. Great. Anybody else? Go ahead. Fantastic. Last question to the group. Theranos.
I love it. Thank you. Yeah, I mean, this is a great thing to bring up. I mean, what it says is we are going to do more due diligence. Fool the valley once, fool it twice. So be prepared. No one's going to walk in, that shiny ball, woo-hoo-hoo, George Schultz joined your board. So, that has hurt, I believe, digital health. It hasn't changed the economics. I think it did make the consumer side of the corporates much more gun shy.
Gabe, women founders.
I think we need more of them. I think it's amazing. I think we need to push Theranos out of the way. That was a special case, and that has nothing to do with the gender.
Female founders rule. Everyone has exited for us. I mean, I wish I could have all female founders.
Rich, last question. Henry Kissinger as a board member. On board members.
That's a nightmare.
But what about the board members?
You want to, I think the construction of your board is actually very important. I think a nice best practice, as much as investors might prefer, and management teams also might prefer to control the board. I actually think the healthiest thing is to have an even number early on, is to have an even number of investors and management or founders on the board, and ideally with an independent board member. It's not always easy to get an independent board member early, and so a lot of companies just say, well, that's not a priority for us. We've got a million other fires we're trying to put out, but I think it can be helpful. It's ideal if the independent board member, of course, is adding more value than someone like Henry Kissinger might add.
But I wasn't sure he was still alive, actually.
He was a few years ago, at least. But I think the moral of the story is you don't need to have generals and politicos on your board in order to have a successful company that
Always
venture
suspect.
backing.
If there's a politician on the board, always suspect.
I mean, and then this is actually a real discussion we had when we met, and that be thoughtful of who you bring to your team, and necessarily these high flying characters and names don't bring you venture capital financings. Thank you so much. It was a great time. I had a fabulous time. Thanks for joining us. It was really
And
fun.
for our moderator here, huh?
Save the big applause for the end. So now it's time for Q&A. So I was going to say it's not a pitch event, no pitches allowed, but Armin took care of that already. So come on up if you've got questions for the panel. We'll take as many questions as possible. We have until 8:30 p.m. So line up here, one at a time. We're going to be real efficient about it. Yeah, no pitches or thinly disguised pitches, but we got them out of the way already. Tyler, come on down. Go for it.
So my question was, you guys touched upon the fact. Sure. My question is, you guys touched upon the revenue aspect and customer intimacy, and also making sure that the product is getting traction. There are certain technologies, like especially in AI, that you can't get to your dream product because you've got to kind of build the data moat, and that's the challenge that we face. So we've kind of automated the first half of a lot of conversations. We're getting revenue, but in a very different use case than our ultimate use case. So I've had investor conversations because we're raising around, not pitching, but I get a lot of pushback saying, oh, we love what you're doing, but this does not give us enough confidence that you are going to get the larger market. But you get into that chicken and egg issue.
Well, there's like a bunch of excuses we use to get people out of our office. That's one of them. The too early, not enough proof points. We just slide open the thing. Yeah, there you go.
Yeah, that is definitely a great point. But I think we are understanding of that, specializing in AI and machine learning. That
thinking
story
about both of those things at the
is
same
very
time.
much one that
You decided
is
to operate it.
common to us. We understand that you need to generate the data. Part of your defensibility, part of your differentiator, is going to be the data that you actually have and the data that you run the algorithms on.
This product market fit keeps changing.
Yeah, Yeah, exactly. But what we want to see is that you have a clear path to getting to your ultimate product, and that the intermediate product is one that is building towards that. I think if we get comfort around that, if we understand the direction and the reasoning for what you are building right now, and why you're spending your time on it, then it's an easy conversation to have.
I think Gabe's firm is more understanding than most on this point. And so I think it's actually, it's a better story to tell if you can about why the initial business that's allowing you to build that data set is a great business on its own. And even without that ultimate business, you could still be a big, profitable enterprise, valuable. You may not be able to tell such a story, but if you can make the ultimate business sound like pure upside on top of what's already a great business, so much the better.
Next question.
Hey, thanks guys for a great panel tonight. Rich, Ephraim, you guys mentioned that there's a ton of money being invested right now in VC capital, and the only time it was close to this record was during the '99 tech bubble, from the graphs I've seen. And then once it burst, it seemed like VC funds dried up for a few years. Is that something startups should be worrying about? Should they be trying to rush to get funding? Or is that a silly thing to be concerned about?
You should always rush to get funding.
Okay.
Yeah, and I think that it wouldn't be, I also think it's prudent to look at look at the execution plan that you're going to deploy against that capital once you raise it. You shouldn't necessarily just make the assumption that, I'm raising enough money for 12 months. In 12 months, we'll be in the exact same environment that we're in today, and the next round will be just as easy to raise as this one. Maybe not.
Well, the dynamic is really different than it was back then. I mean, the amount of capital's there, the diversity of the funds, and the Valley itself is very different than it was back then. That doesn't mean that venture won't get spooked and just slow down, but that even in, and I was an investor both in the bubble and the bubble burst, and what I can tell you is great deals almost always get funded. So just have a great deal.
Yeah, the other point is that the dry powder isn't going away. Even if the venture industry raised $0 next year, I don't know, there's something like $100 billion of dry powder right now. And that money was raised to deploy. It can't just sit on the sidelines forever.
Yeah, worry about your stuff. We'll take care of the other part, okay? You just focus on your thing and bring us a good deal.
So I was going to add just actually to this, if I may. I've been around for a long time, and I've been doing this for a long time. So one of the things is that how much money is raised as venture capital, it depends on whether or not the venture capital asset class is on vogue for pension investors, right? So typically, and again, we're not talking about the smaller funds, but we're talking about the larger funds that are quite a bit larger than 100 to 50 to 100 million dollars. So the pension funds that actually have when the market goes up, usually the pension funds increase their appetite for riskier, investments. So typically, when that happens and these big numbers are raised, it's a little bit of an omen to the venture capital investing and the returns.
No, don't start that. Don't you get started.
I'm not going to get
spook
started.
everybody
but
here.
But I'm not going to spook anybody here because what these gentlemen said was absolutely true. There's plenty of dry powder. The corporate venture capital guys have come in. There's a lot of cash that's in the pockets of the angel investors. So the ecosystem may very well go on without a hiccup, right? So don't look at those numbers. But typically, what happens when there's a large amount of raise in the numbers in the venture capital, because the pension guys will always come a little bit late to the game. The asset classification and the appetite is raised and becomes higher when there's been a long cycle of the upcycle, right? So, but don't be spooked because there is a lot of dry powder, but you may very well see that the venture capital numbers will come down over the next few years. But again, that shouldn't really spook you either. Because actually for founders, the greatest of the great companies have always been founded when there's been a recession going on, when there's been a bad economic cycle going on. So I think you're going to do just fine. Yep.
Next question.
I got two unrelated questions. First one is, it seems to me that the biggest problem in healthcare in the United States is the cost. Everything is a ripoff compared to other countries. And my question is,
The
in
cost to
healthcare-
consumer.
For the consumer, from consumer standpoint, I'm curious, do you guys see any developments that's actually going to bring down the cost of healthcare for the consumer in the United States through all these startups and companies and practically that way?
A fair amount of our investments are targeting that problem. So that's what we're all, in a lot of cases, trying to do.
So it's happening. And my second question was just your feeling on cannabis in the investment community in California, the openness to that.
I mean, it's on fire. I mean, but the first wave of just pure idiocy has kind of almost subsided at this point. But I'm sure everybody's heard John Boehner, is in the business now, so that's great news for all of us. The short story is that we are in kind of a second or third phase of that level of investment. Many of the larger institutional funds are not able to invest there, although the partners are investing directly, et cetera. But all the same tenets apply. And not only that, we're going to lay a whole additional level of scrutiny because it isn't regulated, which means you have to be smart enough to navigate those waters as well. This isn't like, okay, we're going to make it easier because everybody's a stoner, and we're going to make it harder because everybody's a stoner.
Thank you.
If we can get Mitch McConnell into the business, I think the politics of this world will... McConnell too? I thought you said Boehner. Great. Perfect.
All right, on that note, next question.
Go ahead.
Thank you so much. It was a great panel. I actually wanted to ask a quick question about digital health segmentation itself. I mean, it seems like healthcare has multiple segments, but digital health itself is kind of divided into the wearables, the consumer side, the enterprise side. Is there a sub-segment within digital health that seems to be more promising, that gets funded from your perspective in a way easier, or that you are more kind of receptive to? What are some of those trends?
So maybe this isn't the answer you'd want to hear, but one of the filters that we use when we look at these companies is, how is the technology actually going, what is the distribution channel through which the technology is actually going to get in the hands of a patient and benefit the patient? And a lot of the normal, mechanisms that you might think of for doing that actually aren't that great. If you think about physicians, okay, they're not really used to deploying digital technologies. If you think about payers, okay, they don't really have a relationship of trust with the consumers. If you look at pharma, they often don't have a direct relationship at all with the consumers that they serve. And you can go direct to consumer, but that can be very expensive and capital intensive. So it's tough. I think you should all look at your businesses through the lens of what's my secret sauce, not just of my technology and how I help the patients, but how I'm going to get to these patients in a capital efficient and timely way. It's something you have to consider, and it's one of the very first questions we're going to ask. And if there's not kind of some sort of thought about how you're going to crack that code, it's tough for us to get past.
Yeah, I think to Rich's point, that is a great reason to test the market early as an entrepreneur, right? Go out, find if the problem that you're thinking about solving or working on is the correct problem, and who's going to pay for it. That's something that's a conversation that we always have with entrepreneurs when they come in to pitch their company. Who's going to pay for it? Who is the customer? Why is this their need? And can I talk to that customer? So I think that becomes very important. Personally, or with our fund, we skew more to the enterprise side, but that's because direct to consumer is very capital intensive. Consumers are very fickle. it might be a longer tail customer to sell to, but once you have the enterprise, it's a much stronger customer.
Thank you.
Next question.
So my question is, some technologies, some products take a long time to start generating revenue. Okay. How do you, like medical device or pharma? So how do you make that prediction? How do you make what is your metric for saying, yes, I want to invest in this? Okay. Like if there's a device, like a pacemaker, how do you put the initial 2, 10, 20, 30, $70 million is the average that it takes to get a device out?
Yeah, so we used to be a device investor, and we're no longer a device investor because I've got so many arrows in my back, there's hardly any back left from doing that. And the reason that is because really after the 2008 crash, a lot of the dollars and funds that used to invest in that space dried up. And I think a lot of early stage investors like us realized that we're not of a size that we can carry these companies on our own. The later stage rounds need to be, they need to be bigger, and the bigger funds need to support it. For that reason, a lot of the finance activity in that space has gone toward funds that are large enough that they can support it almost by themselves if they have to. For instance, NEA's practice is exactly that. So they're coming to the table in the case of companies like that and saying, okay, we're not going to fund it all up front, but we're going to put the reserves aside such that we can fund this company ourselves all the way through trials and approval and initial commercialization if we have to. And it's great for them in the sense that there's more of a captive market there because it's not nearly as broad-based as broad a base in terms of number of firms that participate as there used to be. So I think medical devices are a little bit of a special case. Therapeutics isn't that way. There's still a large number of firms that invest in therapeutics, but again, they're set up with the expectation that trials take the amount of time that they take, and they've modeled all that out in their investment expectations.
Well, thank you, everybody. Here, back to Rob.
We got 10 more minutes of content to fill. So any questions for the panel?
Well, I was going to actually, if I got a couple minutes, I was
go
going to
ahead.
throw that out there. So I have a different theory on the IoT kind of side of devices. It's a little bit different than Rich's. I think they've become too advanced for most of the life science investors. I think historically those things were diagnostic equipment, imaging, things like that, which they could get their arms around. There was a lot of IP. There was a lot of MDs and clinicians involved. And today that's really morphed into a much more of an IoT, low-cost, other cycle. And so we're seeing other types of investors investing there. So as opposed to going to a life science investor looking to fund your device, we're seeing hardware investors. In fact, there's a conference called HardwareCon coming up, and you're going to see people all across. And what we're seeing is hardware-specific investors. There's a fund right around the corner called Tandem that does specifically that. That's all they do is a device base. And so, the boundaries have kind of broken down there. And those are the folks that will typically will see fund early and give you the momentum to then go to a healthcare investor who's now going to be able to see the light through that. But historically there was this divide between tech and life science in the venture funds, and that's still a huge issue. I mean, I can tell you even one of the biggest funds that I won't name because I have a lot of friends there just went through this, where the two sides almost went to war over something. And, that's not your problem, and you need to stay away from that problem. You need to go find the pools of capital that can get there. And I would go to the hardware guys. Don't go to the healthcare guys. Go to the hardware guys. If it's a good hardware solving problem, they'll get it. Go there.
Yeah, but if it's a classic medical device sort of deal, I don't think they're going to touch it. Having said that, I think you're absolutely right. There are so many tech firms that are starting to play in digital health and healthcare in general. It's really interesting. They used to be so scared of the FDA, and they would only invest in deals that, you know, were more on the consumer side that they didn't think required FDA approval. And we didn't really talk about regulatory tonight, which is a whole other issue within healthcare. But they're starting to dabble in you know, what I would call honest to God health tech companies.
We tweet about it all the time. You know, we've got like our finger on that because there is a lot of momentum going in the FDA. But you know, right now the general thought is Apple is the largest digital health company in the world. Do you agree with that? It's a hard one.
I don't know.
We got more time?
As a percentage of the revenue of Apple, I mean, yeah, it is a big company, but I don't think healthcare gets any revenue out of it.
That's not how they're viewing it. They're viewing it from the standpoint that what they're doing in health records and IoT data, what they're doing on the watch side, what they're doing on the phone side, that they have a very large presence moving into the digital health category. You know, they're shifting to more software and service-based solutions, and they've got, you know, they've sucked a lot of talent and it made a lot of acquisitions now, as well as Google and Amazon.
So I was going to say, certainly, Google's making a huge play on this, and if you look at some of the really heavily invested companies in the digital health, Mindstrong is one of them, right? They just raised another $30-some-odd million, and they're trying to predict, disease, mental disease of the patient by how they move their fingers on their phones. So I think that if Apple is not, or if Google is not one of the biggest digital health players, they certainly will become one, or together they certainly are.
So it brings up the larger question, which we didn't really talk about tonight, of exits in digital health. And I think, as digital health investors, our LPs ask us about this. It's like, well, that's a really interesting emerging space. A lot of money's going into it. It's a little bit exit challenged. I think that, and then, not surprisingly, we turn around and ask entrepreneurs who are looking for financing, well, how big do you think this market is, and what are the natural exits here? I mean, okay, if you build a great, amazing top-line company, you might be able to IPO it, but in the absence of that, who are the natural acquirers of these companies, and what categories do they fall in? And it's often the case that big tech is one of the stated potential acquirers. Amazon buys PillPack, and you mentioned the Apple, the Apple acquisitions, and Samsung is all over this space as well. But I'd say it's not yet a tsunami, and we're it's sort of more of a hoped for thing than something that we as investors can hang our hat on, sort of thing at this point. I'm suggesting that you think about what the potential exits of your company might be. What would the strategic value of your company be to different types of potential acquirers, and then make that, and then state that story explicitly when you talk to potential early stage investors.
Don't tell us what you think, because anybody who comes and says, I'm going public, or I'm going to get bought, we'll laugh at that. But don't laugh at the fact that I'm looking at you as an exit. So when you walk into my office, you are an exit, and I need to know how you're going to get there. The best thing to do is don't try and tell me how to get there. You're going to get there. Lay out an equation for me that I can solve on my own that proves to me that you can get there, right?
I have a question actually from you guys. So pharma is certainly going to be buyer of much of this digital health companies, right? We have two divergent perspectives. So tell us why yes.
Well, I think it depends on the type of company. I think there are a lot of companies that have digital technologies that are very complementary to what pharma is doing. and may have the ability to do things like provide differentiation in the marketplace for their drugs versus other drugs going after the same condition, or extend the patent protection because the combination can be patented, et cetera. I think in those cases, and the other point is that pharma is one of the parties in this whole ecosystem that actually has a lot of money. So if you want to have big exits, you got to look at the companies that have big money because the others aren't doing it. And so they're
exits, right? I mean, if you look at the tech world, sorry about that. If you your mic back. Okay. If you look at the tech world, there's a lot of companies that are selling in the 25 to $75 million numbers right now because they're just additive, sufficiently additive for somebody else. So
I don't buy that. See, pharma, this is a marketing expense to them most of the time. I mean, and I do believe that the combination of tech and extending patents are there. I'm just not sure they're smart enough to get that. I think we think about that. I'm not sure they do. What we're seeing is, you're seeing a lot of that?
I think they all have groups internally that are looking at this very deeply and have very high visibility.
Yeah, I mean, we just still see it as a marketing expense. I mean, clinical trial software, this software, that. I mean, we have I think my joke about two clinicians doing a, neurology project. I mean, the potential acquirers looked at it and said, oh, this is an onboarding tool, all right? I mean, those are tuck-in acquisitions at best. Those are
okay, right? Because that keeps
for us, they're great.
Yeah,
we love them.
keeps
I
the
mean,
ecosystem going.
lots of singles and doubles make a game.
They don't all have to be a $400 million exit. Right?
No,
in
for
fact,
sure.
it's best if they don't because the timeline is shorter.
Right, but the no man's land's the problem. 25s and sub 50s are great as long as you've only taken in 5, 7, 10, 12 million. And the problem is you're 25 or 30 million into this, you have to get 250 plus, right?
Absolutely true.
Very interesting. So you guys see the complexity of some of these issues when you're doing fundraising. So you have to.
We just make this stuff up, by the way.
And I just believe what they tell me. So, so it's again, how much longer do we have to go? We can keep going. Okay, a couple more minutes. So let's talk about the regulatory landscape, right? So, a lot of these digital health companies say that they don't have to go through the FDA rigmarole, right? Because they kind of try to, veer their way to, going through clinicians who are going to be giving the real advice. And so what are your thoughts about that?
So I think it depends. There are some that absolutely probably, won't end up being touched by the FDA. But maybe unlike some firms, we actually like companies that are doing things that are subject to FDA approval. And the reason that is because is really twofold. First, with those approvals comes the ability to go through distribution channels that you might not otherwise be able to go through because your solutions can be actually prescribed by physicians the same way they would prescribe a regular drug.
Sure.
That's one thing. And the other thing is its defensibility. I mean, once you've gone through that process and you have the approval, the incremental value of a second person going through that same process and getting the same approval is not as high. And so there's a disincentive for competition to come along and do the same thing. Now, getting the approval itself can be lengthy and costly, but it depends on what it is. It's not necessarily the case. And the FDA itself, just general comments about the FDA. In my experience with them, they're quite a pendulum. It's a pendulum that swings back and forth from being pretty company favorable to pretty unfavorable, just in terms of the way they're thinking about it. The FDA today has been surprisingly accommodating and willing to fairly rapidly, compared with what they may have done more historically, fairly rapidly accommodate the new technologies that are coming down the pike. And so I view the FDA as pretty good right now. That pendulum will surely swing back.
And it's interesting because, you know, with Obama coming on board, I mean, the 510K process just got so much more complicated, right? I mean, we can actually, you know, pinpoint it in history in terms of which administration came into power and what happened to the FDA. So it's a real issue. Now, last question. So time. Wellness and supplements. So I'm happy for all of you, but I know you were in a wellness company, Gabe, and you've been unfairly silent. So I want to hear some of your perspectives on wellness and supplements companies, which has no regulatory barriers, right? So
yeah, I mean that's something. Honestly, that's something that I don't touch. Something that I don't invest in.
But you were.
I was on, you know, the social side of it. So it was more about engagement, encouraging a community, building a community, getting people to partake in activity. Wellness and supplements, you know, supplements themselves that aren't touched by the FDA but have lots of claims. Not something that I am comfortable with investing in. I don't understand it. I think a lot of the market doesn't understand it. There are a lot of points of failure along the way if you are.
Should we ban supplements? Should we impose FDA regulatory?
It's just not a venture model for the most part. The whole supplement space, and they're very successful. There are plenty of other investors and other mechanisms of investment for the supplement business, but historically, you know, you've got to just think about how we think about it. You know, there has to be an exit. There has to be a multiple attached to an exit. You know, historically, there weren't large, and there still aren't large-scale supplement aggregators that are going to like buy. You're not going to create the new C plus Y plus A vitamin, and then all of a sudden, some, you know, GNC is going to buy you at some amazing multiple. It's just there isn't the mechanism of action to follow a venture model effectively. At least that's our take. I don't know.
Interesting. Great. Again, thank you. We can just keep going. Thanks, Rob.
All right. So check out our YouTube channel, youtube.com/IdeaIPO. The video will be posted in a few weeks. And feel free to stick around, network, socialize, and connect. We'd like to leave the building by 9 p.m. as a courtesy to Perkins Coie. So thanks, everyone, for coming, and we'll see you next time.